When I was a kid and I really liked one of those little expensive, fancily wrapped chocolates, I would ask my sister if she was interested in it too, and I would really hope she would say yes, because then we could buy it together. I mean, sure, it would mean that I could only have a part of it, but that means that at least I get to have a part of it which I wouldn't have had otherwise all by myself. Now, if you're wondering why I'm telling you this little childhood story of mine, because it actually connects to the topic of today, mutual funds. How? We'll get to know soon. So, if you're new to the world of investing and mutual funds seems a little bit like a maze, welcome to this episode where we will talk about the basics of mutual funds, how they work and what are the different kinds in a very simple and fun way. So, let's get started. Now, what is a mutual fund and how does it even work? So, like how my sister and I pooled in our money together to buy a chocolate, similarly, in a mutual fund, investors would pool in money together. Now, this mutual fund is maintained by someone called a fund manager. Now, this fund manager uses this pooled in money to invest in various assets like stocks or bonds or gold, depending on the kind of mutual fund that it is. Since we are investing in the mutual fund, which invests in the stocks, we don't directly own the stocks or the gold, but we own a unit of the mutual fund. So now, every time there is an increase in the stocks or the gold or the bonds or whatever the asset is, the value of the mutual fund increases, and that means our unit of the mutual fund, the value of that increases as well. Now, what are the different kinds of mutual funds? They are broadly divided into three categories. One is equity, which is basically we're investing in like the shares of the companies. This could be great for long term, but they're a little risky. The second one is debt, where we're giving debt to companies or government and we have a steady interest income. And the third one is hybrid, which is a mix of both equity and debt of different proportions. Equity mutual funds can be further categorized into blue chip, which are basically large established companies. Then we have large cap funds, which focus on companies which are in the top 100 in terms of market capitalization. Mid cap, which focus on companies which are in the top 101 to 250 in terms of market capitalization. And then we have small cap, which is basically about after 250. Then we also have index funds, which are basically they invest in stocks which are exact copy of the Nifty or the Sensex, and so they move as per the market. We also have ELSS, which is the investment linked savings scheme. If we invest in this, we also get tax benefits under ATC, but there is a lock-in period of 3 years. So these are just like the basic kinds of funds, and there are definitely more different kinds if you want to get into them, like funds of funds or multi-cap and etc. I mean, now in terms of advantages, there are many. First one is mainly diversification, which means that suppose I'm investing in one particular share of a company, that means all my money is invested in one place and it completely depends on how well the company is doing. So the way to reduce this risk is to basically invest in different places, so that even if one company or one particular asset is not doing very well, it does not impact my entire amount of investment. The second advantage is professional help. As a beginner, if I have only 500 rupees to invest, then I would have to do a lot of research to understand what are the different kinds of assets which are available, which would suit my financial goal and my risk appetite, and then go on to do the entire thing by myself, which would take up a lot of time. But in case of a mutual fund, since it is managed by a professional and maintained by them, we don't have to get into the whole research of things as long as we know what we are putting our money into, the kind of fund based on our risk appetite and our financial goals. The third advantage that we have is affordability. Again, if we take my example of having only 500 rupees to invest, then if I want to invest in something safe, then maybe I would be able to afford only 1 or 2 shares of a big company. But if I invest this 500 rupees in a mutual fund, then with the same 500 rupees, I have now some units of a mutual fund which will invest in various stocks or shares or bonds. So I have a part in more than 1 or 2 shares of a particular company with the same 500 rupees. The fourth advantage is liquidity. In case of some funds which are locked in for a particular period of time, the other funds are open-ended, which means that in case I need money urgently, I can sell my units of mutual fund to get my money. So, like with all, we also have certain disadvantages or risks associated with the mutual funds. The main two risks are, one is the market risk, which means that our money is still in the stock market or the shares of the company. So it really depends on how well the market is doing or how the companies are doing. Similarly, in case if it is of debt or debt given to companies or given to the government, again, if they're not repaying it with interest, our money is at risk. The second one is that we are really dependent on the fund manager and on the mutual fund people to take care of our money and do the investments. Now, if they do not invest it well, or if they do not foresee the trends in the market well, then we would be losing our money, or also potentially notional money which we would have made otherwise if we would have invested it ourselves or put it somewhere else. Another risk or disadvantage is over diversification. Like we spoke about in the advantages, diversification will actually reduce our overall risk by putting in our money in different assets. But the risk with over diversification is that we will not be able to enjoy the good performance or the profits also very well, because it's diluted among all the different assets. The next disadvantage is fees and expenses. So mutual funds, they charge a little bit of expenses called the expense ratio, and sometimes even parts of the sales, like sales charge. Now these expenses eat into a part of our profit or our returns. So, for example, if a mutual fund has a return of 7% but the expense ratio is 2%, then the net return that the investor would get would only be 5%. So the expense ratio and the fees are something that we would have to be very mindful about when we're investing in a mutual fund. So that's it. Mutual funds are all about teamwork, smart choices, and sharing the fun. If you want to know a little more about mutual funds, like what are the common mistakes and how to avoid them, stay tuned for the next video. Till then, I hope you enjoy your favorite chocolate. Bye bye.